I'm happy to visit with you on a beautiful day in the Pacific Northwest and give a brief market update during significant recent volatility. The S&P 500 declined nearly 19% over 7 weeks from mid-February to early April, then gained almost 20% over the following 5 weeks. While still a few percent below the 2025 closing highs, as of May 21st, the index had returned to positive territory for the year to date. Wow. This has been a classic V-shaped recovery where a line on a chart of S&P 500 daily prices will show a rapid descent on one side and then an equally rapid climb on the right side, forming a letter V. Quick recoveries from market declines are relatively common, but once a correction reaches down 15% or more, as happened in March and April, sustained market gains are harder to achieve. This most recent surge was largely unexpected, but the driver of both the sell-off and the subsequent rally was the same: tariff and trade policy. At peak tariff news in early April, the total potential tariff burden exceeded $800 billion, essentially would be a huge cost shock to the U.S. economy if imposed in a short period of time. But then came the pivot. Two announced 90-day tariff pauses on tariff escalation, first with the rest of the world excluding China, then with China, as well as trade deal negotiations announced with both the UK and China. Although the tariff burden today still likely exceeds $300 billion, equity investors reacted positively and now believe that trade deals and not tariffs will be the emphasis over the next 90 days. But this is not an all-clear signal for equities from current levels in our view. Indices are still not back to previous highs, and valuations, especially on a price-to-earnings or PE ratio basis, have returned to elevated levels. Tariff uncertainty remains very present, especially since the first 90-day tariff pause is now half completed and a meaningful trade deal has not been announced. Plus, consumer spending trends are mixed, with pockets of strength, but also some weakness, especially for low-wage earners. In addition, the U.S. federal budget negotiations underway in May and likely extending into June have highlighted continued growth in the annual budget deficit and debt, driving interest rates higher, another possible drag on growth. Balancing those negative trends, however, are a resilient jobs market, steady wage growth, technology investment, and S&P 500 first quarter earnings results that significantly exceeded expectations. Trade deals, if and when they happen, can open up markets for U.S. exports and include commitments for domestic capital investment. Add to this more deregulation and lower oil prices, and we see better visibility for sustained economic growth. So putting it all together leads us to a message that we've repeated several times this year, but remains actionable amid the volatility. Great companies are often able to capitalize during uncertain times, and we remain invested. During times of market uncertainty, it's very important in our view to adhere to long-term investment plans and make adjustments as necessary, maintain diversification across sectors, and once again look to rebalance portfolio holdings by trimming recent outperformers and adding to positions that have lagged. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.